Brad Williams, Frugal Finance, you're an investor. There's a certain lexicon in the industry that you should know or understand. If not, I'm going to go over some metrics, some terminology you're going to find in a lot of common website, Wall Street investing related sites, Google, Yahoo, MarketWatch, etc. Financial performance metrics every investor should know. Evaluating a public company's financial performance can be complicated. Several distinct performance measures within a company's income statement, each telling a different part of the story. You likely come across these measures as you research stock online or read a company's latest earnings report. Understanding them can help you determine how well a company is performing over time and how its valuation compares with industry peers. Here are some financial terms that should be part of every stock investor's vocabulary. Net income, perhaps the most basic profit measure. Net income is what remains when total expenses, such as the cost of goods sold, general and administrative expenses, interest paid on debt, and taxes are subtracted from total sales or revenue. You can also subtract depreciation and amortization, which are non-cash expenses. See more on depreciation and amortization under EBITDA below. If total expenses exceed revenue, this is called a net loss. Earnings before interest and taxes, commonly referred to as EBIT. EBIT is also known as operating profit because tax structures and interest expenses vary from company to company. Setting interest and taxes aside lets you gauge how much a business is earning from its regular operations. EBIT is a helpful measure when comparing the financial performance of two or more companies. EBITDA, interest before interest, taxes, depreciation, and amortization. Like EBIT, EBITDA allows for more direct comparisons across companies and industries, this time by stripping out interest, taxes, depreciation, and amortization. Depreciation is an accounting term for spreading out the cost of tangible assets with a limited lifespan, such as a piece of equipment, machinery, or technology over the lifetime of that asset, which allows companies to reduce their taxable earnings for multiple years. For example, say that a business owns a car that costs $40,000 and expects it to last for 5 years. The business might deduct $8,000 per year as a depreciation expense for the use of the car. Amortization is similar, but is used for allocating the cost of intangible assets such as trademarks over time. EBITDA can be a useful metric when looking at companies with large capital expenditures such as businesses in the utility sector, businesses that might have significant depreciation. There are also several financial ratios that can prove helpful for valuing shares and comparing a company's valuation to that of its peers. Earnings per share. Earnings per share is the measure of company's profitability for outstanding shares of common stock. Common stock shares represent equity ownership in a company. You'll often see two earnings per share measures at the bottom of an income statement, basic and diluted. Basic earnings per share is computed by dividing a company's net income by the number of outstanding common shares. If the company issued new shares or bought back any shares during the quarter, it would use the weighted average number of common shares in the denominator. For example, if a company has net income of 100 million and has 50 million shares of common stock outstanding, the formula to determine earnings per share would be 100 million divided by 50 million, which results in an earnings per share of $2. A company might also issue preferred shares, a different class of stock that doesn't typically confer voting rights but often yields higher dividends than common stock. If preferred shares are issued, the amount paid in dividends on these shares are subtracted from net income before dividing by the number of outstanding shares of common stock in earnings per share calculations. Diluted earnings per share is calculated by dividing net income by the common shares outstanding plus the potential number of shares that would be outstanding if such instruments as preferred shares, convertible bonds, stock options, and warrants were exercised. For this reason, diluted earnings per share is typically lower than the basic earnings per share figure. Looking at a company's earnings per share performance over time can help you determine how a company's profits are trending. Price to earnings ratio. A PE ratio can help you compare the valuation of different stocks. It's calculated by dividing the stock price by its earnings per share. A stock with a comparatively high price earnings ratio trades at a higher price relative to its earnings per share than a stock with a lower PE. In other words, it may be relatively expensive with respect to its earnings. A stock price at $100 per share with a $5 earnings per share has a price earnings ratio of 20. PE is generally used to compare companies in the same industry. Fast-growing companies tend to have higher PE ratios, while firms in more mature, slow-growth industries tend to have lower price-earnings ratios. Return on equity. Return on equity is a profitability measure that's determined by dividing net income by common shareholder equity. For example, if a company has net income of $15 million and shareholder equity of $100 million, its return on equity would be 15%. Return on equity is another ratio used to compare a company with its industry peers. Interest coverage ratio. The interest coverage ratio is a way to measure how difficult it might be for a company to sustain its debt load. It's calculated by dividing earnings before interest and taxes over annual interest expenses, which is the amount a company pays in interest for money it borrows. A company with earnings of $60 million and interest expense of $20 million would have an ICR of 3. The lower the ratio, the lower the company's ability to make its interest payments from earnings. Analysis of the interest coverage ratio might vary depending on the industry. Operating margin. Operating margin is determined by dividing earnings before interest and taxes by total revenue and shows how much income is generated by each dollar of sales. It's a way of comparing the profitability of different companies without having to adjust for differences in debt or tax rates. A company with $100 million of earnings before interest and taxes and revenue of $500 million would have an operating margin of 20%. As with most financial performance metrics, operating margins is best used when comparing a firm's performance with its peers. I'm going to give you an example. I'm just going to go over to Yahoo Finance, and here's an overview of Walmart. And if you go to statistics, you're going to see all of the information, just a rundown of some of their valuation measures. You can see market cap, enterprise value, trailing PE, forward PE, PEG ratio, price to sales, price to book, enterprise value, and on and on and on. And you can see their profit margin, operating margin, return on assets. Over here, we have this other information, and you can look at it. And it goes on and on and on and on and on. And there's some of this is just folly. Some of it is just ridiculous. It's just made up stuff that has zero relevance. But the talking heads on CNBC and what have you like to pump up and fabricate stuff. When you do this, you get an understanding of what the market thinks as a whole. That takes experience in order to grasp what that means. But you're going to find that some of the stuff you hear on the street is just garbage, and some of it is relevant. Just up to you with experience to determine good from bad. Comment if you have any questions relating to metrics. I use hundreds of them when I'm doing valuation. I won't go any deeper than that, but comment if you have any questions as it relates to financial performance metrics. Brad Williams, Frugal Finance. Thanks for watching. Hope that helped. See you soon.